portfolio management class, block 3, portfolio management. Today we are going to start understanding portfolio analysis, and we will carry on with this in the next 4 sessions. The objective of this portfolio selection is that after reading this unit, you should be able to explain and illustrate the concept and measures of return and risk as they apply to individual asset as well as portfolio of asset. At this point, I just want to tell you, portfolio means suppose you are buying one stock and then you are buying another one. So combinedly, you will be getting a return and there will be combined risk is there. So a portfolio is a pool of stocks or other assets, investment assets, which generally an investor or institution invests in. So you will try to understand, you will understand actually, explain and illustrate the concept and measures of return and risk as they apply to individual assets as well as portfolio of assets. Highlight the concept of diversification of risk. We have heard from the childhood that don't put all your eggs in the same basket, because if it breaks, all will break. Otherwise, if you put it in different baskets, some will be saved. The same concept about investments. So if the market goes in different direction, your investment may not give good return. So since there is a risk, as we have studied in our earlier sessions, so you must diversify the risk to reduce the overall risk. Finally, they discuss the portfolio selection problem and process. That's very important. Suppose you are a diehard investor and you have multiple assets to choose from, then how do you choose so that you can get a good return, but also you do not take much risk? And that is generally the human psychology. Generally. So with this objective, we go forward. Now let me introduce. Portfolio is a group of financial assets or investments. So a portfolio, suppose I have a portfolio. Beside my residential house, I can have a flat or real estate. I can have gold, I can have stocks, I can have investment in silver, I can have commodities, etc., etc. In not exactly in the form of commodities, but I can buy in market. So this all putting together is my portfolio of investments, financial assets. As I told you, real assets are cash and other thing. When they are converted into shares, bonds, etc., these become financial assets. Similarly, when gold, you are buying ETF of gold, that is gold mutual fund and something, or gold bonds, it becomes a financial asset. Otherwise, gold is a real asset. Portfolio analysis is a process to determine the risk and return of characteristics. Now, suppose you want to buy, you will buy some stocks. Let us name it. Suppose you want to buy Tata Steel and other Hindalco, etc. All are metal stock. Now you may get a good return if the metals are doing well, but to manage it, you may think, no, let me buy some other stocks also, or invest something in the gold or invest something in real estate, so that if those things go wrong, then I am asset. The goal of portfolio analyst is basically to construct an efficient portfolio. What is efficient portfolio? You will learn later on. Efficient portfolio. What is an efficient portfolio? We will learn later on. Now we'll just a minute. Give me time. Goal of portfolio is to construct an efficient portfolio that balances the risk and rewards of different investments. So, as a portfolio analyst or individually also, mainly this done are by the professionals like mutual fund asset fund manager or portfolio management service fund managers, etc. They try to construct an efficient portfolio. What is efficient portfolio? We will come to know later on. So that there is a, depending on the risk you can take, there is a balance of risk and the return you can get. So everything is not put in the basket. There is a little bit of diversification. There is a return also there. There is some risk is there, and then time to time there is a review and etc. also there. So portfolio analysis involves identifying the assets in the portfolio. First thing you will identify what I should be investing in after you buy your real estate or home, etc., and insurance, etc. You may think, look, okay, everybody is buying mutual fund. Let me buy some mutual fund. Some people are investing in gold bonds or ETF of gold. So you may think, I let me buy. So you have to identify the assets, and at the same time, here also there is some objective why you are investing. As I have discussed it earlier, your objective is also should be clear. Now you have to analyze their historical performance and the risk. That means how many times, what is risk? If I am supposed to give you a return of 12%, but I have given you a return of 8%, sometimes 15%, that means I am varying too much. I'm not consistent in giving you a return. Then you prefer a bank fixed deposit so you get a consistent return. But if you're taking risk and enter into the stock market, sometimes you're getting a high return, sometimes you're getting low return. So you study the old pattern, the past pattern. Third is you determine the correlation with one another. Suppose you have a stock of Tata Steel, you have a stock of Nestle. Nestle means which makes Cerelac, Nescafe, etc. Now, you may find when the market is doing well, Tata Steel is doing well, Nestle is also doing well. But when market is not doing well, Nestle being a necessity product is not doing so badly, but Tata Steel is not doing very well. So the correlation between the two equity investments, stocks, securities, you have to work it out. Similarly, suppose you are investing in the stock market, also you have investment in the gold. So generally, if the stock market goes high, gold should not go high. But sometimes there are aberration of this also. So this determination is important for a portfolio analyst to understand and study. And as we have studied in the very beginning, that systematic study is important to manage your assets. Because finally, constructing a portfolio, what is your purpose? Your investable surplus जो पैसा है, that money you want to put it, build a portfolio so that you can get a maximum return with less risk. Now it is very difficult to get maximum return and minimizing risk, but you try to get adequate return for a given risk. So if the risk hypothetically socho category A, then at that risk you will try to get the best return. Or if you get a return of 12%, you try to find out where my risk is the minimum. That's how you build up your portfolio. You do not build only one. There are multiple assets are there. Assets in the sense there can be shares, there can be mutual fund, there can be multiple shares, there can be bonds or debentures, etc., etc. Right? Now let's move. Now, why portfolio? Couple of reasons are there. First of all, as I told you, if you put all your eggs in the same basket, there is a problem. So diversification is required. So if you are investing in equity, then different types of sectors, maybe steel sector, maybe FMCG, maybe hospital, maybe bank, like that. And sometimes people are suggesting, this is for your information, Indian capital market is only 4% or 5% of the global capital market. So you are missing out 96% of the global capital market. So why don't you put some money in the American market? And that's why government of India allows you to transfer $250,000 to invest. You can invest in equity or real estate or whatever it is in foreign country. So that geographic risk is also diversified. Like some people buy houses or real estate, they have a house, one in Bangalore or one in Hyderabad, one in Delhi, like that. Risk management. By analyzing the risk associated with each investment in a portfolio, investor can manage their risk exposure more effectively. Now, suppose I invest in some stocks and gold and etc. Now I can understand the risk depending on what's happening in the world. Okay, now the suppose you are invested in some companies who are exporting to USA. Now you know USA is very unpredictable about trade and other things. So you may withdraw or you may sell those assets as of now, sell those securities, and you will invest it somewhere else. Maybe somebody who is not connected to the global market manufactures here, sells in India, like Dabur or Marico and etc. companies. Now, one disclaimer is here: the name of the companies I take is at random. There is no recommendation of those shares or those stocks. Return maximization. Portfolios can be constructed to maximize return based on investor risk tolerance and investment goals. Now, this is a very important thing: risk tolerance and investment goals. Now, if you can take too much risk, you can invest into the startup and etc. and expecting a bumper return, but you may not be able to take that much of risk. So then you go for more like Tata's, their management is good, Titan and other things, or Hindustan Lever, or Nestle, like this type of stock. Or you can think, okay, 20% risk I can take, thoda jada high risk I can take. Then 20% risk you can buy some small unknown stock, but which is a good potential to go up, like Zomato and other things as of now. Now these can go up, or Paytm, or some diagnostic stocks which you think will do very well. So you are taking a risk depending on your risk tolerance. And second is the investment goal. When you are investing in a risky asset, you have to wait for the whole thing to play out. Suppose you are saving for some particular purpose, your son's education, your daughter's marriage, your retirement. So then you have to think of it: shall I put it into the risky asset, or I'll put it into the good management, steady products, and they are so historically given a standard performance. So my investment goal also depends on what type of stocks I will choose. Monitoring and tracking. Now if you put everything, and there is also concept of coffee can investing, where say you buy some good stocks, put it into a coffee can and forget about it. That's one way. That there is also logic. But when you are investing in this type of stocks and other things, periodically, say quarterly, they give results, the stocks and other things. Gold, you can find out the Diwali ka time and other price, gold prices moving, etc. So you can always track. And if you think, no, this company I have selected, which is not giving adequate return considering the risk I am taking, let me switch. So regular monitoring and tracking is important, but not daily. It should be quarterly or half yearly. You have to look into it. It is just like your health. You have to time, you have to do diagnostics that everything is fine or not. It's like that. So monitoring and tracking is very important for the portfolio. Last is the flexibility. Portfolios offer investors a flexible way to manage their investment. Why flexible? Because suppose you have invested in equity and bonds and other things, and suddenly equity market is in a very bad shape, you can switch, sell the equity and go totally to the bonds, Government of India bonds, which is totally secured. You'll get less return, but your money will be secured. Or you think that no, good time is coming, Indian economy is doing well, as we have studied earlier, the GDP is growing, so let me put it into the equity. So you can go into the equity. Our discussion mostly will be in the equity and to some extent gold and precious metals. Okay. Although I will refer to commodities and ETFs, I just want to tell you ETF is exchange traded fund. So this is a pool of resources which are invested in a given assets. If it's a gold ETF, they will invest in gold. If it's a silver ETF, they will invest in silver. They will mention it where they will invest. Okay. Now, we have to understand the risk and return. Any investment decision requires an estimate of return and risk associated with the investment. Simple thing. If you want to go and put the money in the bank, you know it is more or less secured up to 5 lakhs. RBI gives the guarantee, your money will be remain secured, and you know the return, it is printed on the board, so you will get that return. Move away from the bank to the share market, you have some of the large companies like Reliance, Tata Steel, Tata Motors, etc., L&T, HDFC Bank, SBI Bank. So, you know, these are well managed, long time history. They have given a consistent return. They have grown consistently. So, risk is comparatively low. Return is steady, but not very high frequency return. So, in practice, what happens is that return and risk of securities are estimated based on historical return. I cannot forecast. I can forecast, of course, but mostly what we do is that we check the past history. Oh, just say I'd like to see that how Tata Steel is done, Larsen Toubro is done, how many times they have not given dividend or something like that, or regularly they have given it, they have expanded it, etc. So now I'll come to the easy thing to find out is the return. Now, what is the return for a holding period you get? Suppose you have purchased here, the example be market T minus 1 money, you have purchased it maybe, suppose last year January. Mein. Now, this year January and last year January ka price difference is your capital gain. And in between, if you have got a dividend, dividend divided by market price, that is the yield, dividend yield. So there are two parts in here. One is dividend return and one is capital market return, capital gain. So this is your total return over a period of time T. Now this you can always find out from the newspaper or various magazines, various websites, another thing, and you can find out different companies which you are thinking of, what type of return they have given. Total return, you know, dividend as well as yeah, year on year you can study. Maybe you have not sold or hold the shares, but opening of the 1st April ka kya price tha, 31st March mein kya, what was the price and what is the dividend the company has declared. So that is the total return concept. Now the above return measure is holding period return on the yield. So it is very simple and you can measure it. Now, finance people never like simple things, so there are little bit of complications are there. There are other two measures of return which you will get in your study material. One is arithmetic average, which is very simple. You try to calculate first year mein kitna, second year mein kitna, third year mein kitna, and then you average, or you add up all the three and then divide by the number of years. That is n. So arithmetic average return is equal to the sum of returns. Suppose 10, 11, 12, you add it up and divide by 3. So you will get the arithmetic average. Geometric average a little complicated, but sometimes it's very conservative. Geometric average return is based on the compound value, because what happens is that arithmetic average means sometimes you may get a negative return or sometimes you may get a positive return and other thing. But geometric average means when you are time weighted and other thing करके you calculate your algorithm is something different, so that you get a total return during the holding period, which is geometric average based on the compound value, is also called time weighted average return. Okay, time weighted average return. Earlier में क्या, I am just taking the average. But in this time, if there's given negative return, the positive return, arithmetic will average will show you a less return. But geometric may be showing you a different return. So in your study material, you will find the arithmetic average and geometric average. Generally, geometric average will give you a low depending on the situation, and arithmetic average will give something different. But I will, or general public will go by the simple holding period return, which is a holding period return or yield, which is very common here. and easy to find out from the websites, from different publications. You can find out these stock or these stocks which where you are trying to put your money. These stocks are giving this type of return. Return is not a very difficult or very complicated matter. It's comparatively simple to find it out. The problem comes when you want to find out the risk of that investment. So let's go to the risk part of the game. Now, statistical measures of risk. Let us now discuss the statistical measures of risk. There are two types of statistical measure. They are standard deviation and coefficient of variation. Forget about the formulas. Let me put it simply. Standard deviation is the one of the most common method to measure risk of an asset. Statistically, the formula I have given to you, where actually what we try to find out, let us try to understand in simple language. I am investing Tata Steel. Tata Steel is supposed to give 12% return annualized. Okay. But I am noticing, and on the other hand, I am looking at another steel company, which is not SAIL. Now, SAIL is also a steel company supposed to be giving return around 12. But SAIL sometimes gives 9%, 8%, sometimes giving 15%. But Tata is giving 12, 11, 13. So Tata Steel का क्या हो रहा है? The deviation is less. 11, 12, 13 का अंदर में रह रहा है. Whereas SAIL में it is 9 भी हो रहा है, 15 भी हो रहा है. It can give you a 9% return, it can give you 15% return. It is supposed to give you 12% return. So that's the probability. That's the probability. So now, with the mathematical formula, we can find the value of standard deviation, but the crux of it is that if it fluctuates too much, that means that stock is risky. We do not like fluctuation too much in our returns. That's the crux of the thing. So the formula is this, where you take the average and then you minus from the different type of outcomes and square it, because there can be negative outcome, there can be positive outcome. If you square, everything will be positive. Then you add it up and take a square root and multiply by the probability. Okay, that's how you get the standard deviation. More the standard deviation, the risk is higher. Less the standard deviation, the stock is less risky. Now we come to the coefficient of variation. ये जो variation हो रहा है ना, उसका coefficient we have to find out mathematically. It is said to be a measure of relative dispersion or risk per unit of expected return. It basically converts, it should be convert standard deviation of the expected values to relative values. The equation of computing coefficient of variation is as follows. So what I am doing here is that per unit of change, how much is the variation is going? That is coefficient of variation. In case the higher the value of covariance coefficient, the riskier is the asset. So if I put in this formula, this is the standard deviation divided by the K, which is the most likely expected return, and if it is high, that means its deviations is very high, that is coefficient is very high, that means it's a riskier asset. So now in this slide we have learned two things. In this slide we have learned two things. One is standard deviation, which is expected return जो है मेरा probable return है 12%, कितना इधर उधर जा रहा है. And second is that we are trying to index it ये रिलेटिवली कितना बार जा रहा है, हमारा जो मीडियन है, मीडियन से कितना दूर जा रहा है ये. ओके, दिस के इज माय मोस्ट लाइकली एक्सपेक्टेड रिटर्न, इससे कितना दूर जा रहा है. So I get the coefficient of variation. So here I understand about the st- same stock का historical data का ऊपर base करके same stock historical data we are getting the risk profile of the stock, and earlier we have got the return profile of the stock. So now one stock के लिए you have return, you have risk, both. Fine. Now let's move to the next stage. Because we are going to make portfolio, we will be adding more stocks. Let us keep our discussion in the securities. So if we have purchased Larsen Toubro, I have a stock, then I have more money, then I thought I should buy some other stock. I should buy some third stock, fourth stock, fifth stock, sixth stocks, like that. And I should have a portfolio of different stocks. To add a little bit of flavor, I can buy gold ETF. That means the exchange traded fund who are investing in gold. So 10% maybe investment in gold रह जाता है. Every people think gold is a little safer asset, or I can buy also some bond, at least steady income एक तो आएगा. So I will get steady return from these bonds. So I can keep some bonds also there. Or I can be a totally risk oriented. I will put it into the equity only. Right? So we have learned now one stock ka return is very easy to calculate and uska risk is very easy to calculate. Now if I move now to the next, this is the same thing which I was explaining you, that suppose there is a stock A, expected return is this is the return matrix and this is the probability. So what will happen is that it will move this side or that side. It will not go very high. It will remain within this. But B stock can go very high, probability mein, and then fall suddenly this or this. So the mean or expected return at the vertical dotted line is the same for both investment. So mean return जो है, average return जो है, mean, same for both the investment. But what is happening? Investment B is riskier. It's going high and then it can come down. Okay. And then, but this, with investment A, the distribution of return or possible outcome is more closely grouped with the mean value. Okay. So this A will be, it will not go high risk, but it will be giving more or less this type of return. If it can give a good time, good better return, not so good time, lesser, a little lesser return. So it can be said with greater degree of accuracy that our forecast will be close to the actual return from the investment A. Okay. When we move from evaluating a single asset in isolation to evaluating a portfolio, now this I am talking when we are talking about one or two stocks. But when we move from evaluating a single asset in isolation to evaluating a portfolio, this risk return dynamics changes. We'll know how. Now here you can see the return on a portfolio of assets is simply a weighted average of return of the individual assets. And you have invested in ITC, you have invested in L&T, you have invested in Nestle, or you have invested in Marico or Dabur or something. So you get a return. Now if you have X percentage, Y percentage, you can take the weighted average and you can get the return. Here is a simple example. A gives 13% return, B gives 20% return. I have invested 40% of our fund in A and remaining in B, that means 60% in B. So 40% will give me return of 15% and 60% will give me a return of 20%. If I add it up, I'll get an 18% return if everything works out as per my estimation. But now the question two comes. Turn to the measurement of the variance of the portfolio return or the risk of the portfolio. Now here पर क्या problem हो जाता है? It is not the risk if you add weightage, the risk is same. It doesn't work like that. Here what happens is that if A is doing well, B not necessarily will do well or may do better, as you have seen it here. But the risk is higher. So we need to understand the variance of the portfolio. Now, when we combine these two, we understand how A and B together act. So I'll give you a small example. Suppose you have purchased L&T, which is a standard good company, and etc. etc. On the other hand, you have bought Jubilant, your Domino Pizza. Now, if the market goes up for some reason or goes down, people buying power or tax is increased or something like that, maybe L&T, because it is already into contract and other thing, will not do that bad, but Domino Pizza खाने का पैसा आदमी का पास नहीं भी रह सकता है. So the risk is different, the variance is different. So my portfolio risk will be different. But suppose A is my Tata Steel and B is my Nalco, and this season Nalco demand is less, then the risk of Nalco is higher. So again the risk will be or variance will change overall, दोनों मिला के. Taking two stocks together or multiple stocks together, because there is a related way may they move. It will be easier to tell you if I tell that suppose Sensex is going up. Some stock moves along with the Sensex, they also go up, may or may not be as per the Sensex. Some stock do not move at all and some stocks go down. Every day if you are into the stock market, you see this. So you need to know when you are selecting stocks, how these two stocks move. It's very good if the two stocks move in the same direction. Bazaar अच्छा है, दोनों अच्छा, both will do well, I will make a lot of money. But when the bazaar is bad, both goes down and I lose a lot of money. So I need to know the correlation or the variance of the portfolio return. As mentioned earlier, assets when combined may have a greater or lesser risk than some of their component risk. Just what suppose I am taking Tata Steel and Larsen Toubro both as same type of risk, then when the time is good, they give a better return. When time is bad, both they give better, kharab return, bad return. This fact arises from degree to which returns of individual assets move together or interact. Is just what I was saying, that if one goes in one side, the other goes the other side, perhaps that is beneficial for me to get an overall return. I am not in too much of a risky. So this is a portfolio ka phenomena hai, because now you are playing with not only one shares, you are playing with 2, 3, 4, 5, 6, 7, depending on how many shares you can buy. So it is vital, therefore, to consider covariance of returns in estimating portfolio variance. What do you need by covariance of the return? Covariance, coefficient of the variation. We'll learn the covariance very soon. So, simple terms में return we will understand, portfolio return we will understand by averaging it, weighted average. But the risk does not work like that, because market के साथ movement of the different stocks are different, and that gives a different type of variance, either positive with the market or negative with the market. So that you need to study. Then only you decide which stock to take, which stock not to take. Now here I will go for the correlation coefficient. We will just know the formula. In your study material you will get the detailed workout problems. Try to understand the basics. That's most important as a investor. The computation of portfolio variance is based on the following formula. This is the formula. Here what is happening, this and this is the here. This denotes the covariance of returns between asset 1 and G. So return on X, return on J and covariance दोनों मिला के इधर उधर क्या हो रहा है, covariance of returns. If it gives positive, it gives negative, it gives positive, this also gives positive. What they give? They give this return. And this ultimately will give you the risk. We start off with most important element of this formula, namely covariance. Earlier you have done it. It is a statistical measure of how two random variables such as return on assets and move together. So what is this? Try to let me make it clear. Suppose return on assets, Tata Steel के assets and Tata Steel का return and Larsen & Toubro का return. Now together, one is their returns, the other is how they move together. Maybe Tata Steel is moving up, Larsen is moving down. Both are giving return. Or it may happen one is giving return and one is giving negative return and they are moving in a different direction. So this you need to study from the historical data using the statistical method. A positive value of covariance, note here, a positive value of covariance indicates that asset returns tend to go together. That is positive value अगर है, covariance is positive. That means asset return tend to go together. That means if Hindalco is also growing, then Tata Steel is also growing. A negative covariance indicates a tendency for the return to offset one another. What do I mean? Suppose Tata Steel goes up, but Siemens comes down. Okay, that means there is a negative covariance between the two. ठीक है, तो क्या हो जाएगा? If the market goes up, you will get a lesser return because the Siemens is going down, Tata Steel is going up. At the same time, when the market moves, maybe Siemens will go up, Tata Steel will come down, and you will get a decent return. So this negative covariance is also a very important concept. Having said that, let me move to the next one. Closely related to covariance is the statistical measure known as correlation. We did it earlier. The relationship is given by how this I and J are correlated. That's what we need to know. Where Ij denotes the correlation coefficient between the return on asset I and that of J. Correlation coefficient. Earlier we studied coefficient of one stock only. If you remember, we read coefficient of variance of one stock. Here we are doing coefficient and correlation. दोनों स्टॉक का, because I have to pick up 2, 3, 4, 5 stocks. So I need to find that whether this matches, this increases my risk, maybe return also, or it decreases my risk, but return will be moderate. So here the outcome is that because you can do the statistical formula in your study material, the coefficient ranges from -1, that is perfect negative correlation, to +1, perfect positive correlation. So -1 to +1 relationship रह सकता है. In between zero, where there is no relationship, that means this index may go high, I may go low, or anything. I do not move. But if it's a negative correlation, then index will go high, I will go low. If it's a positive correlation, index go high, I also go high. I can go higher than index also, or lower than index, but I go high. Negative correlation में index is going high, but I am going low. And coefficient of zero अगर हो जाता है, index moves but I do not move. These are the three situations you can face in the stock market, and you can get the historical data about the different stocks, how they are behaved at different time and in a different way, and consistent किसमें है. Consistency कितने है मतलब एक बार क्या है तो it's a different thing, but if it is a pattern, then it is important for you. Final bold line हम जो दे रहा है, the reduction of portfolio risk is mainly on account of diversification first, because you are diversifying, and you are diversifying with less than perfect correlation between the three stocks or two stocks. Less than perfect correlation. Right? So it should be a little, if it is a positive, it will be negative, +1, so it should be 3, 2, well, नीचे side में, sorry. It should be 0.2, 0.3, or it can be negative something. That will reduce the portfolio risk. That means when the going is good, to some extent this will not go, you will not get a very high return, but at the same time when the market goes down, because there is a negative correlation, you will keep your investment better, and the one which was going high, it will go low. Ultimately, you will not lose that much, or you may be in profit. That is why you have to choose the correlation very well. Just go through it. Two stock देखे, I have done it. Now I'll come to, so far we have talked about putting the eggs in different baskets and etc. etc. Diversify so that it reduces risk, etc. etc. But empirical study has shown, let me read it out first. Efforts to spread and minimize portfolio risk take the form of diversification. It is not difficult to understand that adding more asset in the portfolio can reduce overall portfolio risk. But at the same time, it reduces portfolio return also. However, there is a limitation in adding securities to reduce the risk. What happens? Thus, beyond a level, diversification fails. So, risk is there when you have only one or two stocks. Market can happen something and you are doomed. But you have diversified, you have, suppose I start with Tata Steel, London Tubro, you have Hindalco, you have Siemens, you have ABB, you have Bank, State Bank, you have HDFC Bank, you have AA, etc., etc. You have reduced your risk. And then finally, you find that I am unable to reduce the risk further. So the lower portion, this portion once you come in, this is called non-diversifiable risk. And this portion was diversifiable risk, which are generally company specific. So you are changing the company, adding different type of companies, FMCG, bank, and etc. etc. So you are diversifying or you are reducing the risk. But this is a you cannot reduce. These are risk like suppose suddenly the government changes policy, government changes interest rate, America embargo. So there is always a risk. It may be noted that beyond certain portfolio size, the reduction in risk is marginal and insignificant. So beyond this point or something, now you can ask me, yes, sir, how many stocks if I take is adequate? It depends. Somebody may say 15, somebody may say 29, somebody, it depends on how you have used the coefficient correlations, etc., etc. So that you have eliminated the diversification risk to the maximum possible. You cannot do it fully, but maximum possible. This you cannot because suddenly somebody announces some policy, government policy, or there is a cyclone, or there is EA, it will affect. But many cases is a short-term effect. If the management is good, they overcome very fast. As you have seen during COVID and other things, some companies went bad. Pantaloon was sold off. I mean, future retail was sold off. But some companies have done well, Reliance Jio, Reliance Retail, etc., etc. So this is something different. Am I clear? Hopefully, I have explained to you diversification helps, but beyond a point, it can reduce your diversifiable risk, if I can call it, because you have invested in different types of companies. So each type of company may different type of risk that you have neutralized to a great extent. But beyond that, there is a risk which is non-diversifiable. Inflation, interest rate, sudden tsunami, sudden government policy, etc., etc. So you cannot reduce the risk fully overall. Now let us do some portfolio analysis. Here we'll do some select some stocks and try to see the correlation between them, etc. And I'll give you example of the companies also. We have discussed the risk is reduced when portfolio includes more than one stock in portfolio. The job of investment analyst or any other person responsible in constructing the portfolio is to find securities that are less related with each other in portfolio construction. A very important line, to find securities that are less related with each other for portfolio construction. So if I buy a company like ICICI Bank, I may think, okay, let me buy something of like Hindustan Lever or who are make regular good, essential goods, people will keep buying. So the relationship with each other, I check and then I buy that portfolio. The risk of the portfolio can be reduced to almost zero if the correlation between assets included in the portfolio is equal to -1. Okay, it's a hypothetical situation. If one is +1, one is -1, that means there will be no risk. But that is a hypothetical situation, so almost 1 plus -1 plus 1 is 0, so there is no risk. But it is a hypothetical situation because you cannot invest in the market without the risk, element of risk. Now, depending on the level of correlation, diversification reduces the risk of the portfolio. This I have repeated number of times by this time. The relationship between assets and its impact on portfolio risk is explained below in figure with help of two securities. Now let us say two securities. Here पर B is one security, A is one security. Relationship is minus. That means if risk of B comes down, is returns also come down. Whereas A, risk comes down but return goes up. So correlation is एकदम negative है. इसका रिस्क घट रहा है बट रिटर्न भी घट रहा है, नॉर्मल फेनोमेना. बट ए का है उल्टा फेनोमेना, रिस्क घट रहा है बट रिटर्न बढ़ रहा है. सो कोरिलेशन इज -1. नाउ हियर A and B, A is less risky, but if it is goes up, then return will also go up. And B also, if goes up, the return also goes up. The correlation is 1. They move in the same direction. But there is something called correlation 0.72, as I told you. For A, if it moves, the risk comes down and then it starts going up. Whereas B ka risk also, when it comes down, return also comes down, but after that the risk also goes up. So if you want to reduce the risk, you have reduced the return, but then the risk has started going up and return has also started falling. Whereas A mein, initially the risk was high and the risk was growing, return was growing. After the return is also growing, risk beyond this point, risk is growing but return is also growing. Because the correlation between the two is 0.72. It's taken from a mathematical problem. Figure is more relevant for our discussion since the correlation between the securities is often less than 1 and greater than 0. Less than 1 and greater than 0 is this. In such a situation, when an investor combines such security, risk of the securities is initially lower here. Okay, this 0.72, it's less than 0, less than 1 and greater than 0, 0.72. So initially it is, risk is brought down, return also comes down, but after some time risk goes up but the return does not go up. So these are the various 3 types of stock relationship can happen. Mind that we are discussing only 2 stocks. But when you are building portfolio, there are, or the fund managers or portfolio managers, they are dealing with multiple stocks. So there are multiple relationships comes in. And we have to choose from there which are the stocks we should buy and which are the stocks we should avoid, so that we can give for a given risk a better return, or for a better return we can maintain low risk of the portfolio. Having said this, let's move to the, we are coming to the finale us slowly. How to select portfolio finally? We have given some mathematical, statistical, other thing which you can revise in your study material and other thing, but we have that combination of securities which normally is a risk is repeated number of times. The problem is, if there are large number of securities in the market, how to determine the optimal portfolio which reduces risk while keeping the return constant or increasing the return. And that is all of our wish and plan. First, portfolio selection process. Now here I have to decide an investment portfolio by selecting a mix of assets that is expected to achieve a specific investment objective. I have made it bold and italic. To achieve a specific investment objective, given investor risk tolerance and investment horizon. That means, suppose I am ready to take risk and get a good return. What type of asset I will build it up? And what should be the investment horizon? So, in case of mutual fund, when you are putting the money in a little bit of risk and other capital, people may say that your investment horizon should be a little longer. Okay, when your risk tolerance is there and you want to take the risk and get a more benefit, so your risk tolerance should be higher as well as investment horizons should be also higher. Because if you look at some of the stocks, in the short run, they may not be giving good return, but in the long run, after some time, they start giving good return. Define investment objectives. The first step in a portfolio selection is to define investment objective. Same thing, risk tolerance, investment horizon, other preferences, etc. Identify available asset. Now, once you have invested objective, you have decided that I want to go for high risk, moderate return. Sorry, moderate risk, decent return. Then identify which are the assets which can give me decent return and where the risk is low and what is the correlation between these assets. So you have to decide the asset class. Now this is line is when you are putting money into the equity, bond, gold. So all the asset class ka different type of return, different type of risk, as well as when they are put together, they behave in a different way. So that is the asset class. हम किस तरह से asset class बनाएंगे? How I will combine the assets. And then finally comes the allocation. Not finally, allocation. Now, maybe I will put more on the blue chip or large cap stocks, partly on the small cap, partly on the EA, because the risky is the small caps. Mid caps are future large caps. So I can, that way I do asset allocation, and then I can put some money in the debentures so that some return is risk free and I can get return, etc. So there is an optimal asset allocation I try to determine. I'll tell you how you go for this. Then select specific investment, determine asset allocation, and the next is to you have to select the stocks, which stocks I should buy or which where I should invest my money. Now this is a thing you need to understand very clearly. Now, the issue is how to select a portfolio which is good in terms of minimizing the risk and maximize the return. In the following figure, particularly on the dashed line, there are 5 portfolio offering same risk but different return. Now, look at this line. This is my risk appetite. Now, there is this one portfolio, different combination of shares. This is one different combination of shares. So X is giving the lowest return here. Y is another combination where it is giving a good return. And these are all beyond my risk capacity. These 3 are beyond my risk capacity, but they are also combination of different assets. Now consider the 2 extreme portfolios, portfolio X and portfolio Y. X matlab combination of 2. We are thinking of 2 assets leke. Now this goes up as you increase one stock and decrease another. Maybe the risk comes down, but the return also goes up as I have shown you earlier, and then it moves other way. Y offers highest return for the same level of risk. Risk is the risk. The Y gives me the highest return here, more than the X. We can say portfolio Y below Y जो है, they are inefficient as you would not buy such portfolio with the same risk level to earn lower return. So risk level is this. So you will not buy X ka portfolio or Y because Y gives you a better return. So X lower return there with the same risk. So you will try to avoid that. Now let's go to the next one. Now once you have narrowed down the X and Y, then we get a line called A and B, which is my efficient frontier. Now here you will find many of these 2 combinations are different combinations. So here 1, 2, 3, 4. They touch my efficient frontier. We eliminate all such inefficient portfolio. The new curve A and B connects all left extreme value of the earlier portfolio. Left extreme value. Okay. So least risk here. And थोड़ा थोड़ा बढ़ता है and return भी बढ़ रहा है. All portfolio below this curve of A and B are inefficient. Below this curve, that means this is inefficient because this is the risk is high, return may be, so it is not in as per my requirement. They are all efficient portfolio because of the higher risk, and expected return is also high depending on the investor risk and other thing. Now here you can see that all these are higher risk, but also they are giving higher return. So depending on the investor's risk appetite, they are the right portfolios. So they are also all efficient portfolio because of the higher risk, and the expected return is also high. Depending on the investor risk and return expectation, they can pick up any of the combination. So now, depending on your potential, you can put up this, you can buy this, you can buy this, or you can buy this. You can buy any portfolio. So similarly, mutual fund industry, if you see, there are many mutual funds, and you can buy what suits your risk profile and return expectations. Last, I will touch on Marquis model, because Marquis was one person who got Nobel Prize for his optimization theory in 1952. Mean variance. It is one of the most widely used models for constructing an efficient portfolio. The model assumes that investors invest because of expected return and risk. These are the two factors. There is a risk and there is expected return. The mean variance model aims to find the portfolio that provide highest expected return at a given level of risk, or lowest risk for a given level of return. As I told you, if I am expecting 15% return, what is the lowest risk? Or if I am ready to take risk X, what is the maximum return I can get? That's the model says. The beauty of the model is this. The Marquis model calculates the expected return and variance of each asset in the portfolio, and then combines them to calculate what we have discussed so far, expected return and variance of the overall portfolio. Finally, the Marquis model of mean variance is widely used by investors, financial analysts, portfolio managers. So this model is very much used by mutual fund managers, portfolio managers, and other things. The most important concept Marquis gives is that one important concept that Marquis emphasized for the first time was that some measure of risk and not just expected rate of return should be considered when dealing with investment decision. You cannot have free lunch. If you are doing investment, there will be some measure of risk, and it is your strategy to reduce the risk to get your desired return. With this, today I will stop, and more on the portfolio tomorrow. Thank you for today.